There's several types of mortgages in Canada, and around the world for that matter. A conventional mortgage is one whereby the money is being borrowed for a particular purpose, be it a purchase, debt consolidation, and it's coming in the form of one note, and the money's advanced and the mortgage is registered on the property, and then you utilize the funds for the purpose, whether it be purchase, whatever it may be. The second type of mortgage is a collateral mortgage, whereby you're applying for a product that is going to be further secured beyond your signature by collateral on an asset. That could be a line of credit, for example. It could be another type of loan. And what dictates that is really the methodology behind why you're borrowing the money and how you're borrowing the money from the institution or the private lender. Within the framework of what designates a first, second, or third mortgage, for example, mortgage documents don't actually say first, second, or third mortgage on them. What designates their position on the asset, usually a home, is the date and time that that mortgage is registered. So for example, if you borrowed money from a bank to buy a home and you bought it for $300,000 and you were borrowing $250,000, that mortgage would go on the date of closing when you take possession of the home. If a year later you decided you wanted to secure a line of credit via a collateral mortgage on that same home, then once it was approved and closed, then that mortgage would be registered in behind the existing first mortgage, and obviously at a date and time beyond the original date of the first mortgage. That designates it then as second position. And then if you went further down the road and had to borrow a third mortgage, it would again be registered by date and time. Within the framework of mortgages themselves, there's various kinds of products that you can borrow, and it's getting to be a very wide variety, which is good for the consumer. In today's market, you can get a 6-month convertible mortgage, which means that anytime during that 6-month period, you can convert to a longer term without penalty if you decide that that's not the product for you any longer. Or you can wait till maturity, the end of 6 months, then you can simply renew for whatever term you want. You can go with a fixed term mortgage, be it a 1 to a 10 year, where a fixed rate term is applied to the note and you're guaranteed that interest rate for the term. So if it was a 5-year, for example, which is common, and you got an interest rate of 3%, which is pretty prevalent in today's market, then that mortgage rate would be guaranteed for the entire 5-year term. You can, however, also float a rate called a variable rate mortgage, which means you float with prime. In today's market, generally prime minus 0.55 is a good variable rate product. That would be at 2.45%. However, your rate's not guaranteed. You are in fact floating with Canadian prime, which is dictated by the Bank of Canada rate. And if that prime rate goes up or down, your mortgage rate's going to go up or down. However, within the structure of a variable rate mortgage, just like a 6-month convertible, you have the right to convert to a 3-year term or longer at a fixed rate at that point in time, and you can lock it in if you're getting nervous about the marketplace. When should you borrow a first, second, or third mortgage? It's a very, very broad question, and it really is dictated by the circumstances of the individual and when they need to borrow money and for what purpose. But sometimes it's a good decision to do that, sometimes it's not, depending on really what money the money is being borrowed for. And we take the time to counsel our clients to ensure that they're making the right move at that point in time. Within the makeup of a mortgage, you've got several factors. You've got 1, obviously, being the interest rate, 2 being the amortization, and 3 being the term. The word amortization is born out of the Latin language, mort. M-O-R-T is death in Latin. So amortization means really the death of the note. So if you take a mortgage and it has a 25-year amortization attached to it, and you paid that in equivalent payments over 25 years, in fact, that mortgage note would die at the end of 25 years and the mortgage would be discharged from your property. There are varying amortizations available out there depending on your cash flow. You can certainly go to a 30-year amortization still in today's market. Up until a couple of years ago, we had as long as 35 in the Canadian market. And you can go as low as whatever you want, really. It depends on how quickly you can pay the note off. But that's what the word amortization means. The term is the term of the note. which means the contract term with the institution or the private lender. So if you borrow money, for example, on a 1-year term, that means at the end of a year, that note comes open. You can pay it off in full without penalty, or you can renew it for another year or a longer period. And the same would apply to 5 years, for example. The interest rate, again, as we talked about before, you can have a variable rate mortgage product, you can have a fixed interest rate product, and what really will determine what you should decide on is the education that you're given, the knowledge about the marketplace, the knowledge certainly about what interest rates are likely to do in the future based upon a steady stream of economic data that's made available to our profession, and we willingly share that with our clientele. A prepayment option is something that's given by most institutions, I would say almost all of them, and what it means is that you're allowed to prepay whatever is designated in your contract every year towards principal without any interest penalty. So for example, a standard clause these days seems to be a 20% prepayment privilege. As an example, if you borrowed $100,000 and you had a 20% prepayment privilege, that would mean that you could pay up to $20,000 per year on top of your regular mortgage payments without penalty to reduce the amount of principal that you owe. Is it a valuable asset? Absolutely. However, in today's market, for example, with interest rates being so low on mortgages, it's also advisable for you to look at other vehicles that you could put your capital into that perhaps would earn more than the interest you're paying on your mortgage, i.e. an RRSP, where you get a tax advantage, obviously tax savings in your income year, and your capital is allowed to grow tax-free within the RRSP. And that can be invested in various forms: stock market, mutual funds, mortgages. A lot of private lenders do that with their money. Gives you choices, and you should educate yourself about those. The prime rate is established by the Canadian banking industry, the A-Bank industry. And it's born out of the foundation behind it, which is the Bank of Canada rate. And in turn, if you look at the close association we have with the United States, the Fed rate, or the Federal Reserve rate. And it's basically the benchmark rate that's set by the central banks of the countries in which they operate, and the prime rate is set by the A lenders as a benchmark for their A clientele to be able to borrow at. For example, if you have great credit and you want to borrow a secured line of credit against your house, generally speaking, you should be able to borrow that at prime. And today prime is 3%. So that can vary, it can float, but that's the definition of the prime rate. Interest is charged on a mortgage based upon the declining principal balance. So in other words, if we took a snapshot today of a mortgage for $100,000 and the payment was $800 per month and the interest rate was 3%, then roughly you would have about $350 of that $800 going towards principal and the rest going to interest. However, the very next month, because in fact you paid down $350 of principal off of the $100,000, then your interest would be calculated based upon $99,650 for the following month. So obviously your interest portion would go down and your principal portion would go up. And that is changing every month within the structure of a mortgage. So every month that you have a mortgage at a fixed rate, you're going to pay less interest and more principal over time. Therefore, you're retiring the note quicker as your interest bill reduces. Porting a mortgage is a clause that is in most lenders' documents now, certainly institutional. And what it means is if you qualify at a future date to move that mortgage to another property that you've bought, and obviously under those circumstances you would have sold the one you had the original mortgage on, then they allow you to port it in its existing state over to the new property with all the terms and conditions of the original note. And it can be very valuable because it can avoid you having to face that decision to in fact break that mortgage and can in fact port it to the new property. Most mortgage penalties will be written this way. If you're on a fixed interest rate mortgage, let's say a 5-year term for example, then the interest penalty clause will be stated as such. You will pay the higher of 3 months of interest on the principal, calculated on the principal amount owing at that point in time, or what they call the interest differential. So for example, if you went 2 years into a 5-year note and your interest rate when you borrowed the money was 4%, and you wanted to break it now, they would calculate that and compare it via this method. They would take the amount you owe on the mortgage at this point in time. They would see that you have 3 years left on the note. They would take the 4% interest rate you had on the original note and compare that to what their current 3-year term is. So for example, if their 3-year term now was 3%, then they would charge you a penalty to calculate the interest differential based upon that 1% difference, 4% minus 3, applied to the principal amount owing on your mortgage at that point in time, and multiply that by 3 because you have 3 years remaining on the contract. If that total is higher than 3 months of interest, you would pay the higher of the two. However, if you're in a variable rate mortgage, for example, then the most penalty you ever pay in a variable where you're floating is 3 months interest. There is no interest rate differential. And if you have a collateral mortgage with a line of credit where you're floating your interest rate, you never have any penalty to break that mortgage. That has a privilege within it that you can pay all the principal amount off at any point in time without penalty. Okay, blended interest rates only come into play if, for example, you would like to break a mortgage now and rewrite it with the bank, but you don't want to pay any penalties. So what they would do is they would take your existing mortgage rate, call it 4% again. They would take the amount of principal that you owe, and if you wanted to go, for example, into a 5-year term, and the rate for that was 3%, they would blend the 3 and the 4, and you would probably end up somewhere around 3.6, something like that. That's the best way to define what a blended rate is. You're blending a new note with an old note and coming up with a hybrid, basically, hybrid interest rate. A line of credit can be utilized for a lot of different purposes. If you've built up equity in your property over time, I call them emergency funds. I encourage people, if they can, to take lines of credit rather than leave their property sitting free and clear. The reality is this: the amount of debt you have against real estate is not related in any way, shape, or form to its value. They're mutually exclusive things. So if your home's worth $500,000 today and you own nothing on it, it's still going to go up and down with the market at whatever fluctuation is prevalent. By the same token, if you owe $400,000 against it, it's going to go up and down the same way. You know, we're big believers and big teachers of the OPM principle, other people's money. Quite often you can, for example, the simplest form of that is that our relationship with banks is generally that they use our money. They use other people's money, our money, and they use that to make money with it. So we can reverse that, and the simplest example of that would be, for example, to take a line of credit against your home from a bank, borrow it at prime, 3%, and maybe go and buy their stock, become their partner. Because even in a bad year, banks will generally do 6-7%. So you can in fact extract equity from your line of credit, invest it in ways that's going to make more interest and profit for you. Or if that's not your bailiwick, it's not a bad idea to have a line of credit approved where you have a checkbook handy in case of family emergencies, educational fund requirements, and on and on and on. There's never a shortage for any of us to have reasons to spend money in this world. It's nice to have it pre-approved.